Lovely Father, thank you. Again, thank you for this lovely morning. Thank you that we gather to learn, that you're the ultimate teacher. May you show us the things that are yet to come. May you teach us the way to go. May you light our paths so that we may walk on dry ground, like the Israelites crossed over from Egypt to Canaan. We pray that you give us wisdom from on high, that we'll be better leaders. In Jesus' name we pray, and everyone said,
Amen.
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 Good. Yesterday I found out that only 14% of people can be entrepreneurs. Only 14%, really. And out of those 14%, only 20% of those 14% can actually run enduring companies. So how do you run an enduring company? Unless you have a governance structure. And what is governance? It's my honor and privilege this morning to introduce to you our speaker this morning, Mrs. Mona Sebuliba. Please take it away.
Thank you, Director. Good morning, everybody. And yeah, Director, you have a head for statistics and numbers. I quite envy that. This is a topic we have dealt with before here, ESG, sustainability, dealt with it in detail in the School of Practical Business. But I've had conversations with quite a number of you, Director being one of them, Mark Semakula, CD, Ivan just the other day, talking about the need for some basic corporate governance within our rank and file here at BLN. So it is going to be a bit of an intense morning, a bit of an intense week, because it's quite wide, and the challenge is narrowing it down into something that's workable, but I'm sure we'll get there. Before I get into the detail of corporate governance, just a few things I wanted to highlight, again, from those discussions, is that corporate governance cannot sit outside of or cannot be contained in a business or environment that doesn't have some basic structure and systems. And we will be tapping Mark Semakula, who might be hearing this on the call for the first time today, CD, Ivan, and anybody else who'd like to join us as we come up with a basic handbook for what basic systems we need to have in place. From Ivan's presentation last week, as we were still amazed, and we had a follow-on conversation that there are some businesses that are still run without bank accounts. The separation principle is not in place and that type of thing. And so we just generally want to have a basic, simple handbook or a tool that can guide for what basic things need to be in place before we even go into the complexities or sophistications of sustainability at a basic level, what tools should be in place. So that's something on the side and something we're going to be working on. But I just want us to understand that indeed sustainability, corporate governance, focusing on the environment or social inclusion is a bit hollow if basic systems and structures are absent. So it's a bit like talking about roofing a building before you even say deal with your foundation or even know where the house is going to be built. It's putting the cart before the horse, and that's why we will be focusing on that. I'm going to be condensing presentations or discussions that we had in School of Practical Business. You'd appreciate that School of Practical Business takes about 3 hours, and we have 4 30-minute slots within which to cover corporate governance or sustainability in general this week. I'll do my best and we'll take it from there. I don't know if I'm enabled to share screen or if that can be ignored anyway, because I'll be scrolling up and down a document which might not make sense for now, but which I can share at the end of the week. But I want to start by defining what sustainability is, which is meeting our needs generally as a society without compromising the ability of future generations to meet their own needs. That pretty much is how sustainability can be defined. And the most commonly used framework is the ESG model, which deals with being environmentally friendly, being a socially inclusive business, and a good corporate citizen. But for the purposes of priority, we decided that we should start with being a good corporate citizen, what it means, what the framework is, and should time allow, then we'll delve into the environment and social inclusion. Not that the other two are any less, but once your corporate governance or your ability to be a good corporate citizen is compromised, delivering on your environmental obligations or social obligations will be that much harder, which is why we've started at the last letter of the acronym, which is corporate governance. So quickly and briefly defined, corporate governance is by Sir Adam Cadbury, who defined it as the system by which companies are directed and controlled. The Institute of Corporate Governance of Uganda defines it as a system by which corporations are directed and held to account. But the working definition would be the governance of corporations in an effective, ethical, accountable, and sustainable way to create value for shareholders and stakeholders. And I think the working definition resonates with most of us, especially from a stakeholder point of view, as stakeholder activism has become a big thing, where your customers, your suppliers, your regulators, your employees all have a say or want to have a say in how an entity is run and its values and its proposition to the world in general. So I think we'll go with a working definition, which is indeed an effective, ethical, accountable, and sustainable way to create value for shareholders and stakeholders. There's external governance, and that is usually, that comes through the various laws and regulations, which are formal. There's also best practices. Best practices are not really law, but guides for what is being done in a set industry or country. There's codes and social norms, which are also less formal. So external governance is really delivered through those 4 elements, which are laws and regulations, best practices, codes and social norms. And then internal governance is delivered through policies, manuals, and guidelines, and which policies, manuals, and guidelines are enshrined most times in laws and regulations. So those are the 2 elements, external governance and internal governance. Corporate governance has had a broad and rich history, dating all the way from the 17th century, brought on by the British Trading Company, is when we see it first coming, the British India Company, actually, the Hudson Bay Company, and all these were the companies from the British colonial masters that went out into the rest of the world and were doing trading and that type of thing. So we see it start then, and there was need for individuals who had come together to find ways to manage their business coherently. So that's when we see the birth of corporate governance in its very basic form. Then the Industrial Revolution brought around the next wave, which was between the 18th and 19th century, where we saw mergers and big mega organizations and corporations birthed. So that was the next wave that then emphasized the need to understand how organizations are run, how they are valued, especially as mergers and that type of thing were coming into play. 2000 onwards is when we have seen most big corporate failures, I think, in recent history. The biggest one, I think, being Enron before the global financial crisis. And after the global financial crisis, we then had the COVID-19 paralysis that pretty much brought the whole world to its knees and shut down. And out of the COVID pandemic, we had the reemergence of the word VUCA. Many of us thought that VUCA, volatility, uncertainty, and complexity and ambiguity, first came up in COVID, but no, it was actually coined by Warren Bennis and Bart Nanas in 1985 or 1987, depending on which source, where we were dealing with volatility, uncertainty, complexity, and ambiguity. I think you all remember that word or that acronym from the COVID pandemic. So I won't go into the details of that. As I said, we have quite a bit of limited time, but all this detail will be in the document that I share at the end of the week. But getting into, indeed, the layers of corporate governance, I just want to define who a good corporate, what a good corporate citizen looks like, and a bit of the obligations at the different levels. And then perhaps tomorrow we can get into the details of some of the tools to enforce corporate governance, like boards. So we'll save boards for tomorrow. But generally, there are three layers in good corporate governance, and there's the board of directors, there's management, and there's employees. Again, that will be covered tomorrow. But if we get into the symptoms and signs of weak corporate governance, some of these things are going to strike a chord or nerve with you, and then you'll be able to determine whether or not you run in a sound and efficient manner. One of the basic symptoms of weak corporate governance would be firefighting and crisis management, pretty much as a means of business. And that is one clear sign that systems and procedures are not working. Whenever you're asked for a tax clearance certificate, whenever you're asked for audited financials, and it's a crisis or something to be fire fought, that right there is your first signal that you are failing from a corporate governance point of view. As a leader, as a business leader of the business, you lack the financial literacy to make informed decisions. You are intimidated by basic P&Ls and financial statements in general. You can't interpret them. You can't know what the various implications on a P&L, cash flow statement, or your balance sheet mean. And that right there is a weakness. And that's why we are saying there's some basic systems and procedures you must have in business, which we want to include in that handbook. One of them will be that basic financial literacy. Decisions are not made by the leader, or they're not made by the structures that are in place, the management or the board. There's always some shadow leader in a lot of these private businesses, proprietorships, partnerships. Director has referred to a story where or some advice he gives, I think when he was getting into a partnership, and I think one of the ladies he had partnered with went into a relationship, and suddenly the decisions are not being made by the two people who have started a business. A boyfriend or a husband is now involved in the decision making. So once you have those shadow decision making points that are not clear to the leaders of the organization or the management of the organization, you know you're having a crisis. There's blood accountability. The CEO decisions or the leader's decisions are unquestioned. So beware when, as the leader, it is always your views and your opinions that carry the day, and you are not challenged or do not open yourself to being challenged or criticized or taking other views on board. That right there is also another red herring or signal that you have a weakness in your corporate governance. There's little review. You lack internal audit support, and many organizations or many young organizations will talk about how they can't afford to be audited. I think as one of the basic systems that you need to have in place over and above the financials is an external auditor who can double as an internal auditor, who looks at your systems, your manuals, your policies, and examines that alongside your day-to-day running and management of a business, and guides you on where the gaps are, on how you've not been following your own policies and guidelines, which are also enshrined in the law, which would then help you avoid issues like a slap by Uganda Revenue Authority or that type of thing. So when you lack those type of systems and checks and places, you're weak, your internal controls are weak, and therefore you have no way of knowing whether you're on the right path. That is another signal. You lack financial planning, kind of falls into the firefighting, but this one is usually hallmarked by very high projections, overconfident sales and forecasts that you quite never meet. That is also something you need to watch out for. If quarter on quarter, year on year, you are projecting or forecasting to close at, say, 4x, 5x, and yet in reality, you only do 1x or 2x, you need to go back to the drawing board and look at your tool systems, your analysis, your knowledge of the market. And if you have a good corporate governance system of board reporting into management, those are quick red flags that they will catch if quarter on quarter there's underperforming, but there's also always overcasting. That is something to look out for. And there's the blindfolded marketing. Sometimes you're in a boom, you are doing well as a business, and it is allowing for reckless expenditure. Please recall the caution that I gave that was re-emphasized or echoed by APMO yesterday. We're heading, or we are already in a slowdown or in some sort of recession. It's an inflation-induced recession where we're seeing rising fuel prices, rising food prices, the global geopolitics is at play. And so there's generally going to be a need to slow down on expenditure. So if this year has been good and you're doing quite well, year end or quarter one or next year in general is not the time to be getting into heavy capital expenditure if it can be avoided. But if it is critical for your business, you don't have much of an option. But we just generally must manage our cash flows and how we are managing our expenses. So if you get into blindfolded marketing, and we've talked about pray and spray, or because you're hearing that social media is the way to go for your marketing, you might want to reconsider and be very smart about how you deploy a very limited budget to get or maximize your results. Then the conceited customer relations, over-reliance on a few customers or products, that's something to look out for. When your customer care is one where you're belligerent to your customers, to your suppliers, to your employees, then you have a problem. Then also watch out for when you are very dependent on a few key clients or customers. One, if you are in that situation, you must first identify them and take good care of them, but also work hard to growing your pool of products or customers to ensure that your reliance is well managed. Your HR policies are faulty and you have a high attrition. People are not taking leave. You have low retention. Maternity leave is almost viewed as a luxury. Annual leave is viewed as a luxury. You fire and hire at will. That also needs to be managed. One of the key policies that one must have in place is HR policies, because the labor laws and the labor environment is quite stringent, especially if matters escalate to a court point of view. Courts always look on employees with favor. In whichever circumstance, the employee always goes into that courtroom with the upper hand, and the judges are very much they're very much positioned to want to rule in favor of the employees. So you must, for goodness sake, ensure that your HR policies and practices are enshrined in the law and that you are adhering to them. If there's one asset or if there's one resource that is both your most important but your most riskiest, it is the human resource. Many times we think it is the financial resource, but it is the human resource, and you must take care of it. Another symptom of that is faulty or questionable data. You don't know your market share, you don't know the market size, you can't quite pinpoint the number of customers you have served in the quarter, your numbers are faulty, URA comes to do an audit, you don't have anything to back up the numbers or the invoices that you're presenting. So you better make sure that you have your right documentation. We've moved away, or we're trying to move away from physical filing and move into the cloud. Your databases must be very logically labeled, and a person walking off the street about labeling and finding your documentation, it shouldn't be rocket science. If you find that finding an invoice for 2019 means going through multiple layers, you are in trouble. The basic rule of documentation should be that a person walking off the street who is not familiar with your database or not familiar with your documentation, not familiar with your file, ought to be able to open it and read it from start to finish, and it must make sense. If it can't make sense to a basic uninterested person of good sound intelligence, of good basic literacy, and they can't make head and sense of your filing system, you're in trouble. So it must be very easy to manage, easy to follow at that basic level. And so if it's very complex and you must refer to 2 or 3 other files in order to make sense of one invoice, you're in trouble, and that needs fixing. Late reporting or publishing, this is when you have to publish your audited financials. That's usually for public companies, for banks. But generally, if you can have an internal adherence and say that your reporting or your financial reporting for the previous year must be done by March of the subsequent year. If you're constantly failing to meet that deadline, then you have a problem of data deterioration, which you need to nip in the bud. Then poor board quality, when we get into the board discussions tomorrow, I'll get into the details. So I want to keep it at that level, because tomorrow we'll then get into a bit more detail in how you have oversight through boards. I see we have 20, I've covered 20 minutes, that leaves 10 minutes for a discussion. And I suppose this is the best time to take some questions, comments, or more insight into this topic. It's quite broad, so I welcome other comments or supplements to what I've provided, and obviously questions and comments. But that right there is, sometimes you need to know what it looks, what good corporate governance or what something is by what it is not. So that's what we've covered this morning. And as I said, it's really enshrined in good systems and structures. And I'm hoping that we can get that assignment off the ground in days or weeks to come. Thank you very much. I'm opening it up for questions and comments. Thank you.
Thank you so much, Shepherd Mona. I see Ivan has a hand up. Ivan, please go.
Morning. Thank you, Mona, for that presentation. My question, or my ask on guidance, what would you advise companies who are in the small to medium enterprises, say turnovers below 500 million, in terms of how do they go about the issue of getting their accounts audited externally and internally? Because I think most of them don't sometimes see the value, or it's the cost issue. But how do they go about that to be able to improve on their governance side in terms of the finance?
All right. Shall I take the question now, Director?
Yes, you can.
Okay, I touched on it where I said especially at an SME, sometimes micro or small and medium enterprise, the large ones are well taken care of. There's need to manage cost, and there's need to ensure that you have appropriate service providers so that you're not spending all your money, for instance, on an audit firm or an accounting firm to support you. So there are usually different tiers of these firms that are available to support. And of course, now at this point, for a micro S&M enterprise, I wouldn't expect them to be dealing with the top or the big audit firms like EY, Deloitte, and the like. But there are lower tier audit firms, sometimes that are smaller practices but get the job done. And I believe the Institute of ICPAO, if I'm not mistaken, should be able to provide a database of audit firms or individuals that can help with putting together your financial statements together. And as I've said at this point, the external auditor or the person that's helping with those books would double for your internal audit until such a time when you can separate the two, when you can have your own internal audit that could be outsourced, separated from your external audit. So at this point, it would not be wise to expend too much on very big firms. But they basically, one, ensure that your financial reporting is done, you're complying with what you need to do. They're working with your accountant, or sometimes it's that accountant who has prepared the first set of financials, or they could be the same accounting firm, depending on how small or the kind of budget that you have. And within that accounting firm, there could be the separation principle. The person within that firm who has helped you prepare the financials will not be the same person, say, who does the audit. So there's that to be considered, and it is something that you must do, because any bidding, any work of any corporate nature that is required at a basic level, they want to see some audited financials, usually dating 3 years back. They don't have to be very lengthy or complicated. URA is really on the prowl looking for any unpaid dues. So that's one of the first places they check. So it's increasingly becoming a must-have as opposed to a good to have or a nice to have. And yeah, one would look to those bodies for some support.
Thank you so much. I'm going to come back to that question. Dege, I see your hand is up. Please shoot.
Thank you, Director Grace. Thank you, Mona, for the nice presentation. I just wanted to add to what Mona just shared about financial statements and auditing. Many times, as small businesses, we fear to go to auditors because we think, first of all, I think it's a lack of understanding of why we have to do to have the financial statements and why we need them to have to be audited. Now, the preparation of those financial statements is the responsibility of the business, but why should they do it? It's to help the business understand where it is financially and to be able to make meaningful decisions for the benefit of the business before you look at the external stakeholders like the URAs and the banks and other stakeholders of the business. Primarily, it should be for the business, to help the business. But I also wanted to tell Ivan that there's no need to fear the auditors. Many times it's the cost that puts them off, because when you talk about the PwCs, the EYs, those are very expensive, but there are audit firms that are within our budget range. I'll do, for example, my audits for between about 1.5 to 2 million shillings, and that's your external audit, and it's done. If you're doing a turnover of over 500 million, you just look at, just take a small percentage of, for example, your revenue, and say, if I'm spending, say, 1% or less than 1%, say 0.5% of my annual revenue on external audit, is that such a huge cost to take? No, but the benefits are immense. So it's not expensive, it's doable, and don't postpone it. You can start at whatever point, and then you can build on that going forward. Just wanted to make that contribution, Director Grace.
Thank you very much, Dege, for that wonderful addition. My take would be, now for me, let me come at it from the business angle, because I've been there. I've dodged the audit. I've dodged all these things. I know them. So I have justified the cost or not employing one because of the cost. The challenge is this: when you start a business, two things will happen. Either you will succeed or you will fail. When you fail, it's evident you don't need audit. You have failed. Your stock is back home and you're eating the stock. That's easy. If you succeed, the problem is, because you have succeeded without audit, it will be very hard for you to institute audit later. Increasingly, it becomes harder for you to do the things that you should have done later. And because you have succeeded in spite, you will think that you are succeeding because. Now, those two are separate. you will think that audit is a bad thing, but yet it is important for you to know where you are and how you're running the business. Secondly, so it's not about size or whether you're 500 and below. Even if you have a turnover of, let's say, 100 million a year. There's a friend of mine who worked, he still works with Ernst & Young. So when I needed the company evaluation, I just went to him. I told him, you know what, dude, help me do this evaluation. And he did it as a friend and charged me a friendly price. But he brought the skills of Ernst & Young. So I don't need the headed paper of Ernst & Young. I don't need the partner stamp. All I need is the skill of my friend who is a good valuer, and then we are done. So there's a way we can tap into a skill, but not be able to pay the price tag for Ernst & Young or PwC. The last thing I want to bring in is that the element of faulty numbers. If someone said that in God we trust, all other people bring data. Increasingly, it becomes very hard to onboard an investor if we don't have numbers, whether it be abroad or investors within the country. Lastly, without a sense of governance, we are always one decision away from a scandal. And you will never know what kind of scandal will come crawling your way. And in that case, whether it is URA or internally, recently, I'll tell you, just recently, that's when I got to know that every organization, I think, employing above 20 people, it's a small number like that, needs to have a sexual harassment policy in place. Now, you may wonder, do you have a sexual harassment policy in place? And yet you're working with more than 20 people. So in terms of, that means you're one decision away from a good scandal that will take you out. I like what Mona said, that when an employee takes you to court, the judge is more lenient to the employee. And so the scales are not balanced. It is better that you have a policy in place way early. I've learned the hard way as well. One young girl worked with us 6 weeks. After that, she didn't turn up for work. We fired her. When we fired her, we didn't have a policy in place. What happened? She brought the big guns. She had a sister who knew the law, the backhand of the law. We paid her 10 times her salary for 6 weeks. So choose whichever pain you want to endure. Now, me, I'm coming from a business perspective, purely business. And I hope that you understand where we're coming from. Thank you, Mona. Tomorrow we'll be back with same teacher, Mrs. Mona Sebuliba, to take us through the next stage, which is a little bit harder and better. But it is better that we take the pain up front than pain ahead of time, later in time. It was Jim Rohn who said that choose when you have to have pain. You either have pain up front or later. Either way, either play and have fun or have fun and play. Either way, you will have fun, and either way, you will have pain. So choose when you'll have your pain. Ladies and gentlemen, may you go make money and think about governance and ESG. Thank you, Mona. We'll be back here tomorrow. Call your friends, even if they don't know, they have no clue, call them in and let them learn. It's a journey. It's a journey. Now that you know, let me use the words of Worship Harvest. What are you going to do about it? What is God telling you?
Yeah, no, that homework we'll save for the end of the week in the grill. Actually, start thinking about it. The grill is, and guys, you are about 42 on the call this morning. Grill should not have 10 people, surely.
Exactly.
All right. So thank you all, and yeah, see you tomorrow. Have a good day. Over to you, Director, for the blessing.
All right, guys, may your businesses be profitable and may you implement ESG policies. Catch you tomorrow. Bye-bye. God bless.